Finally, Friday morning, welcome back to Squawk Box. We're going to take a look at the closer look at the Philippine market right now. Year to date, it is down more than 20%, about more than 21.5%. In fact, 28.38 is where we're starting off today. But CLSA, though, says despite macro issues like inflation, a fiscal deficit, and also, of course, as always, politics, market and stock-specific valuations are starting to look attractive. For more, Alfred joins us, head of Philippines research at CLSA, and staying with us from Hong Kong is our guest host, Tom Manhon, regional strategist at ABN AMRO. Alfred, good to see you, and good morning. On the metrics, the market is looking good. 12 times forward earnings, 8 to 10% earnings growth, yield about 3.5%, looking sharp.
Yes, in fact, the Philippine market is one of the cheapest markets in Asia right now, and we're trying to promote the market here in Singapore. We have an investor conference at the Mandarin, and we're telling investors to focus on the big cap stocks once again.
Okay.
History has taught us that in the Philippine market, if there's a broad-based rally, it's the big caps which basically rise first. So we like PLDT, which is the biggest telco company in the Philippines. We like Ayala Corp, which is the biggest conglomerate in the Philippines. We like Manila Water, which is the leading water provider in the Philippines. And if you have a 1-2 year view in the market, companies like Ayala Land, which is down 50% in the last 12 months, and even Metrobank, down 50% in the last 12 months, should be considered moving forward.
All right. Alfred, let's talk about the macroeconomic risks to the market. Philippines is a very large importer, net importer of oil.
Yes.
We have inflationary pressures really very much front and center in the country. How seriously do you think they could prove a drag on corporate profitability, also the broader market sentiment?
Sure. Okay. I think one thing we're telling investors right now is that the situation today, although a little bit bad, shouldn't be compared to what happened in 1997 during the height of the Asian financial crisis. Back then, the Philippines was running current account and balance of payment deficits of around 5% of GDP, whereas right now, because of prudent fiscal management, plus the overseas worker remittances running at about $15 billion per year, we're now running current account and balance of payment surpluses of about 5% to GDP. Admittedly, because we import 98% of our oil requirements, there's going to be pressure on the peso. In fact, we see the peso depreciating a bit this year by maybe another 5%. We see interest rates rising a bit, which should, I think, dampen corporate earnings a bit. Last year, corporate earnings grew by about maybe 20-25%. This year, we're looking at maybe about 7-8% earnings growth. Having said that, the market is down, as you mentioned, 20% year to date. From peak levels last year, the market is down maybe 30%.
Well, let me ask you, though, Alfred, you know, nobody's going to argue with you on in terms of valuations looking attractive, but the flip side is sometimes things are cheap for a reason. You know, you get in on a market which is down 20% year to date, some of the biggest names looking very attractive, PLDT, Ayala, Manila Electric, etc. But what is to say with this whole issue of extremely high oil prices now? The Philippines being a net oil importer, almost 100% of its needs on the crude and product side. That these values are going to go up, or
I think what's going to happen moving forward is, admittedly, I think the price of crude would have to stabilize first. The Philippine market is a small market, probably one of the smallest in Asia, and I would like to believe that the bigger markets would have to rise first, and then the Philippines will actually follow suit. What we're seeing right now is a lot of people are looking at the market right now. People are beginning to ask questions. People are looking at value right now. And I would say that once the global picture stabilizes and once the bigger markets rally, then the Philippine market would come into play once again.
Interesting stuff. I mean, of the handful of the big caps that you know we've run through them, it seems to me only probably Manila Electric Utility,
Manila Water,
probably Manila Water, etc. would probably suffer. Manhong in Hong Kong, you want to jump in on this?
Oh yeah, just some quick comments. I actually agree with Alfred on his analysis. I think the Philippine fundamentals are actually quite strong. The only concern in the near term is just that liquidity. If it is to return to Asia, I think there are a lot of very cheap, much more bigger cap markets, more liquid markets to go into first. However, having said that, we still like some asset classes in the Philippines, for example, the property developers. I think one argument that you can put forward for them is that despite the sell down, there is a lot of value, despite the concerns of interest rate inflation as well, there's a lot of value in these names. They are trading at quite steep discounts to your NAV, and if you are actually a longer long-term fund, long-only fund, you could actually move into these names at very good valuations at this point.
Yeah, in fact, you like names like Ayala Land too, right? Yeah.
I would agree with that. Yeah,
Yes.
I mean, if you look at Ayala Land right now, Ayala Land is trading at a 50% discount to NAV. If you look at over the past 10 years during bad times, Ayala Land would be trading at that kind of a discount. And during good times like last year, the NAV discount was at about 10%.
Okay.
So, I mean, with a long-term view, I think Ayala Land would be a good company to look at.
Okay, good to talk to you, Alfred. Thanks for dropping by.
Thank you. Thanks for the invite.
All right, we've been talking to Alfred D., Head of Philippines Research at CLSA, right next to me, and also, of course, our guest host, Tom Manhan, Regional Strategist, ABN AMRO. We'll get back to him in Hong Kong.